All right, so let's take a look here. Your market outlook for Fed Day. This is the 18th of June, 2014. So crude, we'll take a look at what's going on here recently. All I've done, gang, is I put up a 1250 tick chart. I'm going to remove one of these indicators real quickly so we can focus on pure price action, just like we did previously. So remember, I've got internal strength applied, and we identified in our first session what we call a cluster 2 or cluster 3 trade. All right, so when we look for a cluster, we're looking for signals that cluster within X number of bars. So if I get a turning point, which we see on the chart here as a TP, I get a turning point followed immediately by a black tip. This would be a 2-bar cluster. If I get a turning point and then another bar exists between it, followed by a black tip, that's a 3-bar cluster. Okay? And then what we'll do is we're going to add RSI. So the turning point black tip is based on an internal strength indicator I wrote, and the turning point black tip help identify high probability turning points. We look at them both with trend and counter trend. When I add the relative strength index to that, relative strength obviously is a momentum type indicator, one of the most widely used. And in this particular case, if RSI is overbought, then again, like we discussed yesterday, we apply strength of signal to that. So I can apply an indicator derived from the RSI, or I can look at relative strength myself, so I can also identify bullish and bearish divergence. Right click in the chart, left click indicators. I typically use RSI. I've used a 7-period forever, and recently I pulled it down to a 5-period RSI. So I'll pull this over. So it's a 5-period relative strength index with a smooth set to 1. So basically I can't see the smoothed RSI. Number 2, I've got my oversold at 21. That way if it does hit 20, I can see that it buries itself below this horizontal black line. I'll set the average to black as well. And you can see that I've got overbought at 79, so when RSI hits 80, again, I can see that separation. So that's the classic RSI setting. You can change yours to that, right click, and then left click, set default for RSI. Now, when I've added relative strength to it, it appears at the bottom of the chart. So when we look right here, this represents the relative strength index reading at 79. So obviously when we see black rally above this black line here, we know that we've exceeded 79 or we've hit 80 or greater. For me, that's an overbought condition. This down at the bottom represents RSI 21. So when we exceed it, like we've done here, relative strength is less than 21. In other words, it's oversold. Very rarely will we see a condition where relative strength on a 5-period drops below 5. So a lot of you've been in the classes before. We've talked about tendencies. So what I want to do is I want to start to identify tendencies. And again, those tendencies, gang, come from 2 things. Number 1, what tends to happen when this indicator does this? Okay, so if RSI 5 drops below 10, then the market tends to pop and rally. So we could literally create a very quick trading signal that we could go back in and start to look at. And I do it with an if-then thought process. So this is the power of your conditional statement. If this happens in life, if this happens at work, if this happens with my child, if the dog does this, then I will take this action. It's how we develop trading strategies. It's how we determine where we're going to buy and sell the market, whether we believe it or not. If the Fed comes out and drops interest rates, then this is likely to happen next. If the Fed comes out and stands pat, then. If the Fed comes out and raises, then. If ECB does this, then. If Bank of England does this. If this stuff goes on in the Middle East, then crude oil will continue to rally. All of these if-then statements. So it's a conditional thought process, if this, then that. When I talk to Marius, for example, I say, if this, then this. If I find an inside bar where the high of the bar is less than the prior day's high, the low of the bar is higher than the prior day's low, and the close of the candle is below the prior day's close, then I want to do this next. Then we can say color the bar blue. We can say take the high of the inside bar. We can buy one tick above there. So all of your ideas, thought processes, if I see a double top, we can look at it pattern-based. Then take this action. So just think of everything in terms of that if-then thought process. And it's a conditional statement. If this condition exists, then do this next. If I see a red octagon with 4 letters and I'm driving, then I take my foot off the accelerator, place it on the brake. That all occurs at a subconscious level. Okay? So the if-then thought process. So we would say if RSI. Now our default setting on this parameter would be a 5-period relative strength. This right here, this 5 becomes a variable. It's a variable parameter for this particular indicator. Variable parameter meaning I can go in and modify that. I can say 7, 5, 4, 3, 2s, 9, 12, 18, whatever. So this becomes something in a strategy that we can optimize, and we can find what's the optimal setting for relative strength. Now we can say is overbought, again, a variable. We're going to define what does overbought mean? Well, we're going to say if the RSI 5 is greater than 80, or oversold, and the RSI oversold is less than, and we'll use the numbers that we just looked at, 21. So if the RSI 5 is overbought, greater than 79, or oversold, less than 21, then what do I want to do? Okay? So if we decided to develop a strategy here, we would say if RSI is overbought, and now let's say it's above 94, or if the RSI 5 is oversold or less than 6, then buy next bar market. Now right there we've just created an entry signal based on very specific quantifiable rules of engagement. There are 3 different variables. The value of the RSI, we can lengthen or shorten it. The overbought condition, we can increase or decrease. The oversold condition, increase or decrease. And then we've generated a signal. Now the question is, how do we enter? Well, right here we said let's buy the next bar market. We could also say use the high of bar where our condition is met, and this would be oversold below 6, add 2 ticks, and buy on a stop. I call this a chop stop, and it's designed to help us stay out of bad signals when there's a choppy sideways trade. So our RSI oversold produced the buy signal, and now rather than buy the next bar at market, we can say buy the high of the signal bar plus 2 ticks. That could be plus 20 cents in stocks. That could be plus 30 pips in foreign exchange. Now, that's a static value. We can also come in and say, let's use a variable value. And that variable might say, let's take the high of the bar and add 10% of ATR for the last 7 days. Now we've got a variable component built in. If the average true range for crude oil, like we looked at yesterday, is $1, we take 10% of the $1 or 10 cents and we add that to the high of our signal bar. So there are a lot of different ways to do things, gang. This is just one indicator with 3 variables, and you can see here that we can already move well beyond that. We can enter 3, 4, 5, 6 different ways. So this is why it's very important that you have rules of engagement. Be very specific, and then we have to go back in and test. So let's take a look right here. We've just created a condition. Now we want to go back, and obviously from an automation standpoint, the computer allows us to go identify this condition and then take the action. The cool part about a computer is that it has no emotion. So let's identify an area where those conditions were met. So I'm going to take a horizontal line. We're going to drop it in right here. Okay, so we'll drop it down. We're going to scroll over. And the black bottom half represents an RSI value at 6. So on this bar right here is where relative strength finally declined below 6, right there. So we can look at, now that is the signal bar. So this bar right here represents where our signal criteria were met. Boom. Now that I've identified my signal bar where all conditions are met, I have to determine how am I going to enter this trade. So we talked first about buying the next bar market. So let's take a look at buy the next bar market. So there's our entry bar. There's the signal candle right here. There's the entry candle. We would have bought at the open of the next bar. So this bar opened around 106.44. So we're going to say that we are long from 106.44, and this is next bar market. So we've identified a signal bar. The signal bar is where all the criteria that we've decided that we're going to look for have come together, that confluence. Again, it could be anything that you've ever looked at. It could be if the 20-period EMA is greater than the 50-period SMA, and the 50-period SMA is greater than the 200, and you get an inside bar, then, okay, now we're long next bar market. Now the first thing that needs to come to mind is, what is my initial stop loss? And we typically look at two. We look at a catastrophic, and the catastrophic literally is designed to just put a stop in the market, and with today's technology, NinjaTrader, we can then place the stop automatically just to be sure that we have one in case there's some type of catastrophe. Then we can manually modify the stop. Now, when I manually modify the stop, I'm still doing so using specific rules of engagement. So at this point, we would say, all right, let's take a look at structure. Let's take a look at swing. Let's take a look at ATR. So there are different ways now that we can determine where that stop needs to go. If you do not have a specific way that you are placing your initial stop losses and then trailing your stop losses, you will react based on emotion. And that emotion typically will be you're going to feel strong and powerful and so on when you've had 4 winners in a row. And then you'll be trading from fear and lack when you've had 4 losers in a row. And if I've had 4 winners in a row, I might say internal dialogue would sound like, I'm going to give this one a little room. This could be the big winner of the day. Plus, you know, I'm already up $1,000 on the day. So if I do take a loss versus 4 losers in a row, oh my gosh, I'm down 1,000. I can't take another loss. Or you have a proven way that you place the stops, recognizing that whatever you do has worked historically, thus it's likely to continue to work in the future. And number 2, you've looked at historical data, you know that the numbers play out. So, initial stop loss. Now, as we take a look at the chart right here, obviously a reasonable stop loss would be to look left because structure leaves clues, and I can immediately identify a significant swing low in price right there. So this would be a market-based stop, a structure-based stop. This swing low, I don't care why it was put in. I don't care about the type of candlestick that was formed. What I care about is, A, I've got a black horizontal line there, which means it was probably tested previously. B, from 106.11, the market rallied to 107.14. That's a $1 move, which represents $1,000 per contract in crude oil. So if I bought them at 106.44, and I'm going to take the low right here, which is 106.01, subtract 5 ticks, then my stop's going to come in at 105.96. I'm going to round that down to 105.94. So my risk is 44 ticks down to 106 and another 6. So I'm going to risk 50 cents, 0.5, which is 500 per contract. Reward, if we rally back up and retest the current highs at the 107.10 handle, is going to be, what is that, 65? So you see my risk reward ratio is skewed to my benefit. All right, now let's take a look, and then I buy the market, and let's take a look at what happens. Now remember, this is our signal bar right here. This is the entry bar. Well, if I bottom on the next bar market, the market continues to decline, and it came all the way back down and tested that structure anyway. Well, what if I just waited for that structure? Or what if I said, let's look for this and then wait for a black tip to signal an entry? So let's say we take the black tip and now we buy next bar market. So we'd get long at the open. So right here, we're long from the 106.22. If I use the 106.22 versus the 105.94 stop, I've gotten in 22 cents better, or $220 better. Now let's continue. Now we see that we put in a symmetrical double bottom. So every time we see a double top or double bottom, a couple of things are always present. Number one, the market finally stops the decline and we stop on the left side swing low. This just happened to be at previous structure support. Look at the relevance of market structure. Then we popped up, came back down. So the market finally stopped. This is evidence that there were buyers that came in at previous structure support. We put in a double bottom of visual price pattern. We're now adding to the strength of signal because double tops and double bottoms are high probability chart-based patterns. Then we see that when we put that in, we have a higher reading on the RSI. This is defined as bullish divergence. So if I got aggressive and bottom here, a little bit of pain on the way down. If I wait for a black tip, I got a better entry. If I waited for the double bottom with bullish divergence, I got a better entry yet. So we started our progression with a relative strength index going extremely oversold. But I wanted you to see the difference between A, buying next bar market, B, adding additional technical indicators, looking for that confluence so we can add strength of signal. Now, if we waited for the oversold bullish divergence at structure, we'd be long from around 106.15s. And then we had a little thing called a rally. And that brings us to where we are right now. So as I look at this chart right here, we can see a lot of different ways that we can trade price action. One of the best being patient and just waiting for markets to move towards, into, test previous levels of structure support, previous levels of structure resistance. So as we set right here, gang, we're literally in the middle of the 107s to 106.10s. It's a $1 trading range. Right here, if I buy them, the market could come all the way back down here, test these swing lows, and then rally back here. Am I willing to buy them at 106.70 and put stops all the way down here? I would be, as long as I see that I've got 1.5 or 2 times that reward available to me. But it's likely that if I buy 106.70s, we're going to go test the 107.20s, and then we could see resistance just like we did here. So, rules of engagement, over and over and over. So as we see crude oil, I have a key price point or an area of interest. I call this down here the bid zone. So I'm going to buy them up 106 to 610. Now obviously I'm going to look for a qualified signal on my trading time frame. I have an area of interest up here, okay, 107.10 to 107.20. Now let's come in here. We've done our pre-market higher time frame analysis, and then Viola. I've got big DSR levels down here at the 106.15 handle, And that's right where I've got an extreme low that produced a $1 rally. Oversold lower high bullish divergence that produced a nice rally. So clearly this is a great level for me to look for long entries. Number 2, I've got a DSR level up here for my day trade at 106.95 to 107s. We know that it popped as high as the 107.20s. So again, I've got to be willing to put my stops above 107.20 if I'm going to be a swing trader at that level. So we're using our higher time frame analysis to identify key price points. And we do a couple of things. Number 1, if I'm a buyer down here, we would master this with position sizing. Okay? So if I have a day trading signal, I do my normal size for the day trade. So I'm going to trade 2, 4, or 6 at that level. One of those is going to be defined as the scalper. One of those will be the trader. Then, because of the significance, it's a key price point from a higher time frame. Because of that significance, I might add a 2 lot for a swing trade. So a great example of that recently is the British pound, when we took a look at the 6B. So let's go look at that on our higher time frame. And again, the 6B is the futures contract for the British pound. We did our analysis on the significance of that 170 handle. So we've sold him here, covered here. Sold him here, covered here. But then I've got a 2 lot on a swing trade. And that swing trade is going to look for a decline to those much bigger levels around 165 and then eventually 160s or 62s. But because of the significance of this level, I'm also going to day trade at near this intraday with qualified trading signals. And then it's a 7-year high from our weekly chart. So I like putting a swing position out there. It may take 2, 3, 4 weeks. And again, I could be wrong. But because of the significance of that level, I definitely want to go ahead and allocate some capital to that swing trade. So higher time frame analysis, trading time frame. Let's go take a quick look. Where's the NASDAQ yesterday? We bought and sold the NASDAQ. Absolutely perfect scenario. Were we geniuses? Absolutely not. We came in, identified key price points from our higher time frame in our pre-market analysis, and then we waited for qualified signals at those levels. Those qualified signals were produced in intraday. Our rules of engagement were met, and we saw a beautiful 20 or 30 point move between those 2 levels. So as the market rallied right here, we already had multiple tests of this 37.84 to 85.86 region. There was our qualified sell. This was a SOS 4 real-time intraday. Go plus 4 or 5 on the scalper, let the balance run. I think we did 12 to 18 on the balance. Then we pulled down, structure support right here, pulled right down, and at 10:09 we had a qualified buy signal, rallied right back up. So you can see when these markets move sideways, the turning point black tip is helping identify these key turning points as they occur real time. Guess what? If we see a rally back to 83 to 85s today, then we look for a qualified sell signal. The other thing I'm seeing right here on the higher time frame real quickly, from this swing low to this high, pull it back to here, and then let's look at an ABCD or 1-to-1 measured move. So there's perfect symmetry right back in to that level. Okay, then all you have to do is pull your NASDAQ chart up. There's the 150 tick, and watch your intraday levels. If we don't have a DSR level there at the time, then you can simply drop in a horizontal black line to give you a visual of where that key price point is. So remember, gang, over and over and over, we talk about in the course throughout the sessions, what do I see? What does it mean? What do I do? So I know that when I see a black horizontal line on my day trading chart, it means that's a key price point from my higher time frame analysis. I know that it's a potential setup for a swing trade, and on that swing trade I can add 1, 2, 3, whatever my position size is for that. I also know that if I do put on a swing trade, that my stop, ISL, initial stop loss, for the swing position has got to respect my higher time frame chart. So intraday, we typically risk 4 to 5 points to make 4 to 5 points in the NASDAQ, and then let the balance run with fib dots trail. But I may have to use a larger stop on my swing trade so I can respect recent swing highs or low from the hourly time frame or the 1250 tick, whatever you're using. So if I'm a seller here, note I've got a spike high over here. So am I willing to risk 15 points up to a 38.01 stop? Well, let me look left. I'm going to say if they break above this level, where are they headed next? Wow, that's pretty significant. So I would have to risk up to the 38.02 handle, because it's highly likely that although the market breaks above this structure resistance, that if they do go higher, we're going to see a significant stopping point at that 3800 handle. So I'll drop this guy in right there. That's another visual reference. Now let's look left. Well, all-time recent highs. Okay, so I've got to respect that level. So NASDAQ traders, if we get a qualified signal 3783s to 85s, then regular intraday qualified trade and potential swing short entry. Okay, same thing, Dow Jones. Dow Jones, we've got big DSR levels coming in, 16,750s right here. Okay, so we've seen a little sell-off. We still have no qualified signals. Now, you'll note right here, gang, that we opened at or near the previous close, so there's no gap potential. Number two, we declined right here. Again, look at this extreme oversold condition. We went down to like 7 or 8. Turning point black tip, so this is a beautiful cluster 3 buy. We've just gone new structure low, lower high. So there's a turning point, overbought. Now let's see if we get a black tip sell right here for a possible continuation move down to this next DSR level. Yeah, I'll do an aggressive trade. We'll go ahead and pop it over here. Let's get a 2-lot. Remember, we looked at this yesterday as well. So there's a turning point. Like to see a black tip. I'll go ahead and put that aggressive short entry out. Things will likely slow way down. Now we're going to take a look right here. I'm going to go 741 on the stop. We'll go 02 on the target, or retest of these lows, and then we'll see if we can make new structure lows here. What does our HTF look like? Higher time frame, Dow Jones. Shocking. Previous structure support, once broken. Anticipated resistance. Look at your turning point black tip right there. RSI's overbought. So this sequence of events right here is turning point, SOS1, black tip on the next bar. So that is a perfect example of a cluster 2. Right here, I've got an RSI overbought. So it's RSI overbought SOS1, turning point SOS2, black tip SOS3. That's a cluster 3, 3 different technical indicators showing confluence, all at structure resistance. We roll right back up yesterday. We got overbought here. As we rallied, we made new highs with bearish divergence. Look at the RSI reading right here. RSI overbought, higher high, bearish divergence. Look left, structure resistance. Turning point, followed immediately by black tip, sell them. What's the expected move? So we've got interest down here at 16,645s. See this swing low right there? Okay, so if I'm a swing trader and I buy 642s, I've got to put my stop below that low. I'm expecting them to dip back down in here, possibly retest these lows. So protective stops have to come down to probably around 14 on any swing trade long entries. Okay, so there's the Dow Jones. Areas of interest. 745, 750s. We know that we've got that DSR level hanging out up here. So anything back against this level, we like the short entries, intraday and potential swing sells. All right, so got those set up across the board. Now let's take a look at S&P 500. S&P tightened even further. Bull continuation pattern with a breakout to the buy side. Now you want to talk about range contraction. So let's look left and let's identify. Turning point black tip, there's a cluster 3. Turning point black tip, look at this guy right here. Great example of oversold bullish divergence, but we're in no man's land. The market declines, we go oversold. Here's a turning point, 2, 3 on the 4th bar, we get a black tip. So that's a cluster 4. We then pull right back down and produce this beautiful symmetrical double bottom. Now, if I buy the right side of this, it's aggressive. Why? I'm not back down into this structure support level at the 1924s. I'm 2 points above it. Thus, if I buy it over here, I've got to place my stops below these swing lows. Respect market structure. How do we do that? Always look left. Structure leaves clues. Again, price is the truth right there. Okay, so if I wait for the black tip, buy the next bar market, that puts us long around 28.50s. Immediately, I want to look left and identify structure. So my reasonable target is a retest of this structure resistance, and then obviously I can trail on my fib dots. All right, so let's look over here to the right. Now we've been in a series, big time congestion, only a 2-point trading range yesterday. We got a quick little pop out right here to a new structure high, and I've got a big honking black line above that based on 1938s as you look left over here. So S&P's got plenty of room to run. Previous structure resistance here, once broken, new structure high, anticipated support. So if I buy the 35s, then I'm looking for a move to 38s. If I buy the 35s, then my stop has to go below the swings right here. So probably risk 3 to make 3, and then let the balance run. Russell. Yeah, and then if you go to the S&P, you might want to go 2,500 tick, 3,500 tick, a lot more volume. There's the Russell right there. So we talked about these levels. I got short right here yesterday, afternoon session. Not a big trade. You know, it was boring, but picked up 350 on the way down here. So you can see that we pulled right back down to this level. We have a spike high resistance. Once broken, let's expand the chart here. Structure resistance, we pull back, previous support holds at support. We know we're in a bull continuation pattern. We retest the previous high, make a new structure high, followed by the anticipated higher low. Where does this higher low exist? Look left, previous structure resistance, once broken, anticipated support. Boom, overbought, higher low, bearish divergence, sold them here, risked about 300, and again, you know, 350 for the day. Now, let's take this guy and let's just extend it over here. So I've got interest where? 1165s on the Russell, and then if we were to rally back into this 74.76 handle, low risk short entries. And again, look at this, gang. RSI hit 94 right here. I'll pull this guy down so you can see it. It's a very rare occurrence, and I've got this set up as a trading signal. So if RSI is greater than, then look for a cluster 2. Turning point black tip back to back. Little pullback right there. Looks nice, nice, nice on hourly charts, 4-hour charts, daily bars, and really helps identify significant swing highs and lows on weekly time frames that we can trade around those levels. Okay, so 1165.66 buy zone or bid zone, 74.76 offer zone. If I buy them here, then reasonable expectation, $8 move back to the 74s. So again, real easy math. If I buy 66, cover 74, that's 8 points. So I could risk 4 points down here and put my stops down at 61.90, well below structure, and still produce a 1 unit of risk to 2 units of reward ratio for that particular signal. Analysis of a trading strategy. I pulled this up earlier, so we'll take a quick look. So we talked yesterday a little bit about the this FIBDOT strategy, and again, it's just a momentum breakout strategy. We've got to be aware of strengths and weaknesses. So this right here in NinjaTrader takes the strategy performance behind me. This is a multi-contract strategy. Again, very, very simple momentum entries. The goal here at the level 2 is to put us in the position, get us out at that scalper target with 60% accuracy or better, and then let the balance run so we can manage it. Now, this right here takes a look at the distribution of profits. Okay, so first I ran the historical numbers, and we can take a look here, 3370 on 36 trades. Okay, now on this particular trade, I went lower frequency for the higher winning percentage. The profit came down about $800, but I cut the number of trades in half. Okay, now let's come over here and let's go to graphs, and we're looking at our distribution. We're going to look at all trades, long and short, all trades winning and losing, and then we're going to base it off the time of entry. Okay, all based on central time zone. So trades that were entered in the 8 o'clock hour produced about $450. Regardless of when this trade exited, what's more important to me is I want to know the time of entry. Trades that we entered on the 9 o'clock bar, which is 9 o'clock and 1 second to 9:59 and 59 seconds, made $1,000. 10 a.m., good distribution, 825. 11 a.m., again, that's an entry. This bar may have exited at 2 o'clock in the afternoon, but my interest is in the time of entry. So I turn it on so I can capture the first move in the morning and then let it trade. So there's the distribution. From here, we can also go take a look at the equity curve. We can look at entry efficiency. Entry efficiency is at 67%. If it's above 52, it's better than a coin toss. So my entry efficiency is better than a coin toss. Exit efficiency, about the same, better than a coin toss. And again, this is a 2-contract trade. Now, in order to arrive at the distribution numbers, for example, I went through and I tested. So I tested by using my start and end times on the strategy. Okay, so I left-click on the strategy, and right here are my variables. So here's my FIBDOT value. 1 lot for the scalper. I'm going to risk 23 ticks on the scalper to make 29. Then on the trader, I'm going to assign 1 contract to the trader. I have no target assigned. I'm risking 24 ticks, and then it's going to trail based on the FIBDOTs, and those FIBDOTs are going to be set to 1.618. Okay. Now, Marius also wrote in, if target 1 is hit, then do you want to bring the stop loss to break even? We can say yes, true, or no, false. Sometimes the market will pop, go grab target 1, pull back to at or near entry, and then go and make significant new highs. Do I want to trail my stop on the FIBDOT after the scalper is hit? True. What value do I want to use for that FIBDOT trail? 1.618 based on the HMA. All those variables written in. I'm going to start it at 8:55, so we had a couple of signals that occurred on the 8 o'clock bar right after I opened it on a 1,000 tick chart, and then I shut it off at 11:55. That's the 11 to 12 o'clock candle. Maximum drawdown for the day, so I can set a max loss. Okay, so just to give you an example, 2-contract trade. And I went back in and I looked at the scalper. by itself. Looked at the degree of accuracy when we just risk 23 to make 29. Okay? Yeah, because again, I'll come in here and when we get range contraction, I'll come in and turn it on and set it to a 1 lot. We've seen ATRs declining across the board. Again, 7 or 8 year lows in foreign exchange currency as an example. So with that declining ADX, with that declining ATR, the volatility in a non-trending range, I can come in here and say, okay, let me trade the scalper only. Yeah, it's based on the 1,000 tick chart right here. So you see we just got a scalper sell. All right. So when we look at the strategy, a couple of things that I want to identify. We talked earlier about the if-then thought process. We talked earlier about conditional thought process. Okay, so we're basically saying now, let's take the conditions that we've identified manually and let's automate them. So remember, level 1, rules-based, but then the trader enters, stop, places the initial stop loss, exit. Level 2, rules-based. The strategy enters, places the ISL, and places the targets, and can trail the stops if I want it to. By design, this guy is, I want to get to a break even or better for the trader based solely on the scalping contract. Then the trader manages the balance. And this is what I did in the prop rooms in Chicago, the best thing that we did for training traders. I can trade multiple markets. So I can have this thing running on 6 different markets at the same time. I get an audible tone. When my criteria have been met, it puts me in the trade, places the stop. Then all I have to do is go look at that chart and then apply my basic rules. If I get a buy signal right into a massive DSR level, I can immediately reduce my position size and modify my stops and targets based on the additional information. If the market's just broken out of a DSR level and I get a buy signal, I can change my profit target and I can let that trade run because I anticipate we've just broken a structure resistance, a key price point, so we're likely to move, just like we saw yesterday in the mini Russell. As soon as the Russell took out that level of resistance, that DSR level, we had a massive directional move. Well, this signal picked up a buy right after that and caught the majority of that long entry. So it allows me to track multiple markets, and again, gang, it removes the fear of entry. So right here, criteria were met for a scalper sell, so it sells a 2 lot. 1155.80, boom, and hits profit target 1 right there, a 52.90 for the scalper. And then it says, if scalper is hit, then what do you want me to do next? Well, I have it set to trail the stop based on the fib dot value, and then we've got a variable that says take the value of the fib dots here and add or subtract X number of ticks. So in this case, it was 5 ticks. We broke above the 1155 fib dots, and the stop loss was hit at 1155.50. So you can see that the target right here, we come in here and grab the ruler and say, okay, what percentage of the maximum favorable excursion is the target picking up? So we had $440 available at the absolute low from the point of entry. And we pulled out 29 ticks. So we could have gotten more right here from the buy signal. Okay, left click once on the entry, then take it to the highest high right here. Now again, let me pull this over to the right. So from the long entry right here, the highest high was over here. Now, this was at 4:30 in the morning, which means that I would have had enough margin to carry it overnight, which I don't want to do typically. But on the maximum favorable excursion, you'll see here intraday from the entry at 11, this trade hit target 1 at 12:04. Well, that's outside of my time of day feature. So the signal was generated right here during it, and then I got stopped out of the trail right there at 1:03. Yeah, so this allows me to come back in now and make judgments based on those filters. Okay, I have a question about the trader position or the trader contract, which is C2. Okay. If it gets a further target 30% of the time but contributes to a full loss 100% of the time, wouldn't it be more profitable to take both off at the scalping target when you compare? Great question, Kevin. So here's what you got to do. Let's look at expectancy. Let me just take a quick look, gang. Crude oil, okay, sharply unchanged. Went up here. Look at this, gang, real quickly. Look at the importance of respecting structure. My stop was at 38. If I left my stop at 38, we're stopped out. I looked left and put it above these swing highs right there at 41. Came within 2 ticks of our stop, and now we're up money. Okay, because of the extreme excitement, I'm going to take the scalper off at market, let the balance run. Beautiful example right there of respecting market structure with stop placements. Okay, let's do a quick update there. Mini Russell, nothing going on. Okay, so we take a look at the expectancy, and actually it's about 45% on the extended. So the expectancy formula, we take the average win times win percent. Okay, so let's do those numbers. Let's say that the average winner for target 2, Kevin, is $200. And now let's say that that $200 target is hit. Now that's not right. I know it's bigger than that. The average winner on that extended is 420. Now this is a relatively small sample size. This is over that 52 trades that we looked at. Okay, and the win rate was 0.43. All right, now let's go grab the calculator. So we take the average win in dollars, multiply it times the win percentage. So we'll go 420. Again, some of them much larger, some of them not quite so big, times 0.43. 180.6. Okay, so we'll move this out of the way. Now our average loss, remember we were risking 23 ticks on the second one. So the average loss will be the full $230. We take that and multiply it times. If we win 43%, that means we lose 57% of the time. $230 times 0.57, 131.10. So we take the 180.60 average win times percent winners, subtract from that the average loss times percent losers, and we wind up with basically 51.50 as the expectancy per trade. $49.50. Now, if we maintain that over the next 100 signals, average win right here times percent winners. So the expectancy on the winning trades, I need to get back on Lumosity. Okay, so you see here that this has room to run. So we can pull this down. I could actually win 40%, we'd adjust this right here. I could lose 60%. And we'd still wind up profitable. Right here, we can probably go down to around 35% accuracy, and we're just shy of a 2-to-1 ratio right there. So again, it's imperative. That's the expectancy formula. Elder talked about it all the time. But again, in order to get to this expectancy formula, what do we have to know? A, we have to have a rules-based strategy that we can test. Now, we look at the expectancy here. We can also flip-flop this. So we can take this expectancy and we can say, now, what if I win 120, or no, actually our profit target, we set to 290, and then here we were risking 240. And we were winning 65% of the time, which means we're losing 35% of the time. And then we can work the expectancy that way. Or we could take the entire position. But very, very good, valid point. Because if I've got a negative expectancy on the trader contract, then it doesn't make sense for me to apply my capital to that contract. Okay? So if I look at each one of these contracts as an employee, I say, okay, I'm willing to allocate $2,500 or $2,000 of my intraday capital to you, scalper contract. Now you go out and do the best that you can in the market. And every time I put the scalper on, I hit target 1 right here. I feel good. And then as the market goes here and here and here, I might say, oh, I should have stayed long. Okay, that's rookie mentality. That's not understanding expectation. That's why I have the second contract. Now, if I come back in and I say, okay, rather than taking the exit here, let me expand my fib dots to 2618, which means it'd be below here. That would allow me to stay long, not get stopped out here, not get stopped out here, and instead get stopped out over here. But that requires I hold that position overnight. I don't want to do that. My margin triples. Okay? Then there are other times when I look at this and say, man, I sold it here, I profited here. Oh, I should have taken them both off. Again, that's to presume that at this point right there, you knew that this market wasn't going to go any lower, which again, we don't know. Now, the reason the level 2 is so powerful is because you can look left as a trader and say, hey, you know what? My RSI's oversold bullish divergence were approaching previous structure support. And then I can trail my stop more aggressively here, or I could exit the trade. So the key thing here for me, gang, was I wanted to get it to where we have a profitable strategy to that first target. And then whatever happens after that is in the trader's hands. So again, right there. When I'm looking at this buy signal in real time, obviously I see it come up, and I see, you know what? We just bought it here. Beautiful. Basically, we had oversold bullish divergence, but you know what? We just made a new structure low. Buy it here, target 1 hit. As this market went right back to this previous resistance that had been support, my RSI's overbought. We retest with bearish divergence. We get a black tip sell. I might say, that's it. I'll go ahead and take it off here. But then I have to live with the results. If I take it off here on the second at 11.59, then I made $480. And in this particular case, the market pulled back here, so I outperformed the strategy exit by $200. And it felt good because this market rolled back over, and then by the afternoon session, we'd rolled back over down here. So for this particular trade, that was the best outcome. But it could have done this, pulled back, and then gone boom, straight north right here, left me long, and that second contract could have produced $1,200, consistent with what we saw yesterday. So yesterday, we saw this big directional move in the Russell. Right here, we had our beautiful buy signal. Long entries, fill the gap, scalper hit, balance off here, and then I took an aggressive short. Had we just stayed long, once they took out the DSR level, boom, $1,200 on the second half. Now again, these aren't very likely to occur with this type of consistency. Remember what our ATR, we covered 100% of the 7-day ATR right there from 11:58 to 73 in 46 minutes. Again, not going to happen that frequently, but when it does, we can participate. Now, more times than not, the market will come right back here, have this extreme overbought condition that we see right here. It'll stop, put in a double top, and it'll reverse and come back down here. Okay, so I can come back in, take a look at the signals, and then obviously the other thing we look for is what's the tendency when we have losses. Look at the sideways trade here. So here we suck down into a trading range that's only 5 points wide. So during that sideways range, we go boom, long entry, target one hit, balance out near break even. Short entry, stopped out. Long entry, stopped out. So we go 1 for 3 right there. Well, what were the conditions in the market at the time? Sideways. Completely sideways. This is a momentum directional system. So again, we expect that this is going to happen in sideways trades. And then once we break out and we get directional moves, that's where we look for the thing to pick up those nice directional moves. So back here, did we have a directional move? Yeah. We got long right here, 66.30. Scalping target hit, balance out on the trail stop. There's a nice $660 winner. And you can see that we exited near the swing highs. So we maximized our profit potential right there. Then immediately we roll back over, we get a sell, boom, target one hit. From the short entries at 1170.80, our lowest low was 64.10. So $670 of opportunity, and right here from the lows, we got out about $350 higher based on our fib.trail. Okay, so Dow's rolled down. Now remember, our initial profit target was down here for the scalper at the 06. Now I've got a new DSR level that just built here. This DSR level is based on a higher time frame. Okay, so it wasn't here previously, but we set our DSR levels to 4 times our trading time frame. So left click on the indicators. This is so I don't have to continue to flip back and forth on the charts. So I'm using a 932 tick chart to generate my higher time frame DSR levels. So when my criteria are met on the 932 tick chart, this appears on my 233 tick chart. Now RSI is oversold, SOS1. Where's the market relative to? I'm at a DSR level, SOS2. Look left, I have structure, SOS3. So if I'm aggressive, this is an SOS3 buy. This is the left side. I don't have a double bottom yet. So let's see if it pops up and does a double bottom here, then I can buy the right side. As it sets now, I can trail my stop to 1 tick above entry, or I could cover for profit right there. Now, if I cover and the market rallies, I'm a hero. If I cover and the market breaks that support and comes back down to my higher time frame area, which is this 680, then I've just missed out on another 25 points of profit right there. This is why we have to have rules of engagement. Okay? So RSI oversold, SOS1, same thing every time. Where's the market relative to? I'm at a DSR major, SOS2, structure, SOS3. It's the left side. There is no double bottom here yet. Okay? So if I wait for the double bottom, and the market goes here and then just goes straight south, I never got a signal and I can stay short. That allows me to participate in that directional movement. Okay, so let's take a look here at different ways to manage the position. So first of all, what is the current position? We say if short. So we're going right back to what we discussed previously with our if-then thought process or our conditional statement. And again, this is exactly how we might write the code. Okay, so if the current position is short and RSI hits oversold and we're at DSR level, then what action do I take? Number one, I can exit at market. Number two, I can trail stop aggressively. Number three, do nothing. Trail the stop based on the way you typically do it. So what this does, this brings rules, very specific quantifiable rules to this condition. So my current position is short. Short based on what? We did the turning point black tip sell. The market had gone new structure low, lower high. We got a turning point black tip. We took the short entry. I used my 2 contract ATM. The stop was placed here. I looked left, identified swing highs. I moved it above the swing high, which allowed us to stay short right there. We pulled back down. I covered 1 at market for 1 tick. And now we're back down into this area. So if I leave my stop right here based on my regular rules of engagement and the market pops back up, this trade basically is break even. If I leave my stop right here and the market comes back up, goes sideways, and then drops, I keep my short position and I have opportunity as the market rolls back over and possibly heads down to this level. This level I know is the lows from my higher time frame analysis. How do I know that? I got a big fat black line right there and I can look left. Okay? So again, very simple. Now, if I don't have a specific rule for how I handle this, I'll handle it differently every time. Again, if I was up money, I would do one thing. If I'm down money, I might do another thing. How do I feel today? What does the market feel? Oh, this is really boring today on this Fed day. So I'm not willing to sit here in these markets any longer. So I'm going to take profits. And then 27 minutes later, the market's down here. And now I'm upset with myself. And then I start the negative internal dialogue. What were you thinking, you moron? If I trade the cluster 3, which just set up right here, then I could reverse the position. So let's do that. So we made 9 ticks and now we reversed. What's the signal that we just used to get long? RSI oversold, SOS1, turning point black tip, there's a cluster 3 buy. We're at a DSR level. Well, what if the market rolls back over and goes lower? Then I get stopped out. Currently, I'm at 693 on my stop. Look left. I'm below the swing low right here. Okay, so there's 699. I'm going to go 94, 1 tick up. And then I'm going to go ahead, since we only did a single, and we'll just see if we can get it back up here to that 39, retesting that structure right before that key price point. Let's take a look. It's purely for repetitions. Not only that, but we have clients that have smaller trading accounts, and it's easier to manage. So if we take a look right here, you'll note most of these trades, it's risk 15 to make 18, and then there's one very particular trade where he'll just allow the stops to trail. Okay? So obviously, if I traded a 2-lot, this would be minus 150 per or minus 300 on the trade. Okay, 170 is what the scalper made. That trader may have made $500. It may have made 110. But the single contract, after $20 taken out per trade, nice performance, single market. So again, if you want to trade one contract, one market, and then basically 3 primary trade signals, this is an easy way to just focus. And it gets the repetitions out. I put this together yesterday to take a look at the combined equity curve for the 2 months. So that's April, May, updating to June, first 2 weeks right now. Yeah, now again, there'll be some days when there's just not a lot going on, other days where you feel like a rock star. So what you should do is trade a single contract and then go ahead and manage the balance of the trade and record. So for example, right here, if I just risk 5 to make 5 in NASDAQ, There's my target hit. Now I would be flat in real time. But I could go ahead now and I could record, had I trailed my stop at the fib dot minus 1.4 ticks, then my contract 2 trader would have produced X, and do that for 1 to 4 weeks. You'll see typically that the second contract has a lower winning percentage, but over time when we get those big directional moves, especially in trending type markets, like a mini Russell, like crude oil, this guy will produce more profitability. So if my psyche is weak and I'm trading from fear, I'd almost rather get in and get out, because I don't want to set through all of this, because for me, I've associated this in my mind with pain. I want to get in, I want to get out. The sooner I can get in and get out. And then some traders set that limitation for themselves psychologically, choose never to address it or break it, then you can go ahead and just increase position size. So if we take a look right here, it's very easy to say, okay, I've decided I'm going to go from trading a 1 lot to a 2 lot. So we take all these numbers right here and just double them. But you still trade the exact same way in real time. I still use the exact same rules of engagement for entry. So as we scroll up, here was a double top cluster 2, and it was a counter trend sell. Okay, initial stop loss 15 ticks, target 1, 104.01, $170, 17 ticks. And then the rules of engagement, if the target, or if we're within 3 ticks of the target, the stop moves to X, and so on. So it makes it easier to focus. And then some of our clients do single contracts, 1 month, 2 months, get really comfortable with 2 or 3 signals, 1 market, that's it. They don't look at the mini Russell on a bad day in crude oil and go, oh, I should have traded the Russell today. Because it's irrational, it's illogical. What they'll do is they'll go for 1 or 2 months, become adept at that style, and then just increase their contracts. So now I trade a 2 lot. Then I go from 2 to 3, 3 to 4, 4 to 5. And obviously those numbers can get very, very big very quickly. All right, there's crude oil down into our key price point. Now let's see if we get a buy signal down here. Crude oil 150 tick chart. Okay, here's crude. Yeah, we'll look at 07. I think it rolls Thursday. Okay, so there's that big, massive level. Yeah, good job. So a couple of you already long crude oil. Now let's take a look right here in crude. Again, if I had my limit orders resting at 106.11, I'm filled right there. And already there's up 16, 17 ticks. So we're approaching target 1 right there. If I'm a swing trader, I'm looking for a move back to the 680s and then the 720s. And we likely could see some response in crude oil in the afternoon session. Typically, the Fed news is going to come out around 1 to 1:15 Central Time, which only leaves 30 minutes left in the crude oil day. Okay, so exact same V bottom that we saw right here. RSI's buried, SOS1. Turning point right here, SOS2. Previous structure support, SOS3. Great example. Now, intraday, let's pull this back down, and let's take a look at crude oil. I'm at a key price point in crude. So let's see if we drop down here and then potentially get a symmetrical double bottom. Here's our oversold, lower high, potentially retest here with bullish divergence, and then we can look for a day trade as well. Look at that. Beautiful buy. And by the way, I told you about that extreme strategy. There's that RSI extreme strategy I told you about. So when our initial criteria are met, it starts to tell me and alert me. And then the long entry would have occurred right there at 106.11. All right, traders, let's take a look at this Dow Jones. Okay, so here we are on the right side. So we've identified the setup. Now again, I want to show you the difference. I'm more aggressive. So we're in on the aggressive side. Okay, A, I did the cluster 3 buy here with the color rotation. B, there's the retest of that DSR level with bullish divergence. Now, if you're waiting for one additional piece of information, then wait for your color rotation filter. Okay, so remember, CR, color rotation, if I'm a buyer, I want to go from black to white. And this is a filter. So we're filtering trades based on one additional criteria. So right now, if this market continues to sell off, what would we need? We need A, an oversold condition on the left side. B, we need a retest of that left side low with bullish divergence. I buy it on the right side, I want to get a better entry. But C, the final thing would be to wait for the bars over here to turn back to white and then buy next bar market. Okay? So, oversold, lower high, retest with bullish divergence. Oversold, lower high, bullish divergence on RSI. At structure, we'd expect it to come back down and test 16,700 and at a DSR level. Now again, let's look left. Let's look at the perfect example right here. So at one point, this signal looked exactly like what we're looking at right now. This made an oversold condition. It made a lower high, and then it retested. On the retest, we had bullish divergence on the RSI. I bottom right here. If you wait for the color rotation filter, then we've got to wait until we get a white bar. Then we buy next bar market. That's one more piece of technical information. Here's the sell signal right there. Okay, so left side overbought. Right side bearish divergence. Wait for the black candle. Same thing. Oversold left side, bullish divergence right side. See the turning point black tip? Boom. There's my color rotation. Buy the white candle. Yeah, so over here on the right, we can take a look at this and say, okay, if I waited for the filter, would I have gotten long? Well, right over here, we still have black candles. Okay, so now let's pull in our Excel spreadsheet. And again, market's extremely slow today, which is unusual due to the Fed. But right here, we come over and in June, we could say we bought a double bottom, and then it's SOS 4. And then over here in my notes, I can say no color rotation confirm. So I know that I did not wait for my bullish color rotation to confirm the signal. So if it's a stop out and I put these notes in, I can come back through here and see I took 7 trades where I didn't wait for the color rotation to confirm it, and 5 of them were losers. So what does that tell me? Wait for color rotation. I'm going to get in a little bit later. What if I took 7 trades with no color rotation confirm and I had 5 winners and a loser, or 2 losers? Okay, then it's just confirmed that I don't need to wait for that color rotation. Now if I don't do that, all I'll do is I'll look at what the result or outcome of this trade was and then maybe make a decision based on that. What happened most recently? Did it cause me pain or pleasure? Again, that's the horrible way to do it. All right, gang, here's our buy in crude oil, key price point. So we talked about 18 tick target 1 plus 180. Fib dots are plotting at 0635 minus 2, 33. Okay, so now we're locked into 190 on the second, which brings our total there to 370 on a 2-lot in crude oil. Great trade. Now again, remember, this was based on our pre-market analysis. Look left, nice big fat DSR levels over here. And again, that's a cluster 3 buy. So this is a perfect example. On day one, we talked about 3 different ways markets turn. Number 1 was a V top or a V bottom. There's a classic example of a V bottom at a key price point. We drive into it, stop on a dime, and rally hard out of it. Stop now goes to 34. Locking in $210 on the second piece. And again, you can see, nice move. 05 straight north, 45 cents in crude oil, 50% of the current ATR covered right here, very short period of time. A lot of buyers down here at that level. Why? Significant price point. And again, you can see here on crude, from that swing high, turning point black tip sells yesterday, it took a while. We got down here, double bottom buy, got back up, and there's the buy again. So those of you that are still long on the swing trade, again, targets up here at 09s, 107.09 for right around $1,000 a contract. So on the Dow, if I was waiting for the white candle, look over here. We go oversold, lower high, bullish divergence. And again, this is very, very simple. It just takes you saying it about 100 times. So you can go back in and look at charts intraday. You cover 4 markets for 1 to 2 weeks, and you'll have this down pat. Oversold, lower high, bullish divergence. Turning point black tip on the right side, there's my white candle. So you can see my average price is 16,710 entry. I would have bought right here. If I waited for my white candle, I'd be long from 709. So there's no real difference in my point of entry. Yeah, so that is the color rotation confirm right there. Now again, could this still roll over and stop me out? Absolutely. But that's the difference. Buying the retest here is more aggressive. Waiting for the color rotation right here. One more piece of technical data. It filters out trades where we come down here and then just continue south. But typically we do get in at a later price. Okay, so target 1 plus 18 balance out right here on the trail stop in crude oil for 210. So 390 on that one, all flat crude. Now, if we pull back down into this region, I want to see if we get another qualified signal. We can also look for a color rotation. We want to see white candles and then a close back above the fib dots. See if we get a directional move back into that 107 handle. And you see that we've got a big DSR level right up there at 680, 690s.